Hey everyone, Mark here, back for another video, and before we get started, I want to wish everyone a happy new year. Here we are in 2022, and what better way to begin our year than discussing some of the top ETFs to consider for your portfolio this year. ETFs are great for any portfolio. You can either be a hands-on portfolio that's looking at your stocks on a day-to-day basis, or you can be a hands-off investor. These are particularly great investments to build firm foundations for any portfolio. ETF stands for Exchange Traded Fund, and really what these are a basket of stocks. It could be a wide range of stocks with hundreds and thousands of different positions, or it can be a more focused ETF that's focused on a particular sector, like a technology sector. In a video I just did recently, I discussed some of the top technology sectors to consider for 2022, so I'll put that link down in the description below for you to view if you haven't taken a look at that yet as well. But an ETF is great to build your portfolio on because it'll provide diversification with these numerous positions that it owns. You're not banking on that single stock risk that you have when you invest in individual companies. So in today's video, we will discuss some of the top ETFs to consider for your portfolio in the year 2022. If you're excited to go over some of the top ETFs to potentially add to your portfolio, then do me a huge favor and hit that thumbs up button, as that is huge for the growth of this channel moving forward. And consider subscribing so you'll be notified anytime we drop a new video. With that being said, let's jump into the video. As always, everything discussed in this video is for educational and informational purposes only, so please do your due diligence before investing in any stock or ETF mentioned in today's video. If you are new to investing and this is going to be the first year you begin investing or investing for retirement, consider opening an account with M1 Finance. They have regular trading brokerage accounts there, and they also have retirement accounts like IRAs and Roth IRAs that you can open. But if you use my description in the link below, they will give you a free $50 just for opening and funding a new account with $100 within 2 weeks. Also, if you're interested in cryptocurrencies, you can use my link down below to open a new account with BlockFi, where they will give you free Bitcoin for opening and funding a new account. All right, with that being said, let's jump in to the very first ETF to consider for your portfolio in 2022, and it's going to come as no surprise. It's going to be the Vanguard S&P 500 ETF, stock ticker VOO. Many of you know that I love the Vanguard S&P 500 ETF, as this is a foundational position in every portfolio. It's going to give you that broad range of stocks that tracks the S&P 500, which so many fund managers and investors today use as a benchmark each and every year. Over the lifespan of the S&P 500, the average return has been roughly 8%. In terms of returns, over the past year, the S&P 500 has returned 27%, and over the past 3 years, the average annual total return for the S&P 500 has been an astonishing 20%. Now again, over the lifespan of the S&P 500, the return on an annual basis has been around 8%. So you can see how these numbers that we've been seeing over the past 3+ years has been so strong for the stock market. So in terms of the top 10 holdings, these stocks make up 30% of the entire ETF. And they include Apple, Microsoft, Amazon, Tesla, Google, Nvidia, Facebook, Berkshire Hathaway, and JP Morgan. One of the great things about VOO, not only does it track the greater index, which we already know, but it is also considered a low-cost fund. The next ETF to consider for your portfolio in 2022 is the Vanguard Information Technology ETF, stock ticker VGT. When looking at the sector breakdown, VGT is focused solely on technology. They are invested 91.7% in the technology sector, followed by the financial sector, which has 6%, the industrials, which has 1.4%, and the remainder between communication and consumer cyclical. When looking at an ETF like VGT, we've already had a clear understanding that they focus on the technology sector. So you're going to see a lot of the crossover, the same stocks, similar stocks that we saw with the S&P 500 due to the fact that some of the largest companies in the world right now happen to be technology stocks. Now the weightings are going to be a little different from the S&P 500, so let's take a look at the top 10 holdings for VGT. The largest holding for VGT happens to be Apple, but the weighting, which with the S&P 500 was much lower, here it is 20%. The second largest stock in this ETF is Microsoft at 17%. So between the top two holdings in this ETF, they make up nearly 40% of the entire ETF. The next largest holdings in this ETF include Nvidia, Adobe, Visa, Salesforce.com, MasterCard, Cisco Systems, Broadcom, and Accenture. Overall, this ETF has a total of 365 total holdings, whereas the top 10 has a weighting of 58% over the entire ETF. So if you're looking for an ETF that has strong technology exposure, this is a ETF that I highly consider due to the fact that it's low cost. Again, similar to VOO, this is also a Vanguard ETF. And when you look at this ETF, you're only going to pay an expense ratio of 0.10%, meaning you will have a fee of $10 for every $10,000 you invest in this ETF. The next ETF that we will look at to consider for your portfolio is one of my favorites, and it is the iShares Dividend Growth ETF. Stock ticker DGRO. With this ETF, they are focused not just on dividend stocks, but particularly on dividend growth stocks. So companies that are increasing their dividend at a strong clip on a year-over-year basis. With shares of DGRO, you're going to get a dividend that is near 2%. And over the past 5 years, we have seen this ETF increase their dividend on average 10%, which is solid dividend growth for a dividend investor. Next, let's take a look at the sector breakdown. So with VGT, we saw that they were solely focused on technology space. They had over 90% of their funds invested in the technology space. Here with DGRO, we're not as focused on a particular sector as much as we are focused on dividend paying stocks, dividend growth stocks. So the top sectors for DGRO include the financial sector at 20%, the technology sector at 19%, healthcare at 16%, the industrial sector at 12%, and the consumer defensive sector at 10%. Taking a look at the image, you can see the remaining sectors there, but overall you get the idea that this is a ETF that has spread out its funds into numerous different sectors and is not solely focused on one particular sector. Turning our attention to the top 10 holdings, which are made up of Microsoft, Pfizer, Apple, JP Morgan, Procter & Gamble, Home Depot, Johnson & Johnson, Verizon Communications, Broadcom, and Merck. The fund overall has a total of 393 total holdings, and the top 10 makes up roughly 27% of the entire ETF. The next ETF we will discuss is one you may not be as familiar with, but it is one of my favorite sectors, and that is the NETLease Corporate Real Estate ETF, stock ticker NETL. Now, for those of you unfamiliar with NETLease, these are REITs that own properties and they transfer all of the landlord costs over to the tenants. This includes insurance costs, property taxes, and even maintenance costs. So as a tenant, you're not only going to pay rent, but you need to cover all of the property taxes and your maintenance and all of the different things that go on at the property. As a landlord, you're just going to sit back, buy good properties, have good tenants, and collect your rent checks. This is exactly what a NETLease REIT is. NETL is a bit of a newer ETF. It's only been around for a few years, and over the past year, it actually returned 22%. So it lagged the S&P 500 a little bit, but we saw a late surge in REITs, and this is looking to continue as REITs are a great place to invest money during inflationary periods. In terms of a dividend yield, you're going to be quite happy because you're going to have a dividend yield of 4.9%. Again, REITs tend to pay very high dividends. Looking at the top 10 holdings, if you follow REITs at all, you may be familiar with a lot of these names. Let's take a look. The top 10 holdings for NETL include Stag Industrial, WP Carey, Realty Income, which is otherwise known as the monthly dividend paying company since they pay monthly dividends, National Retail Properties, Store Capital, which happens to be one of my favorite net lease REITs, Lexington Realty, Innovative Industrial Properties, Broadstone Net Lease, EPR Properties, and Agree Realty. Now, when it comes to holdings, this ETF is much smaller when compared to VGT or VOO and the others we will discuss today, as it only has 26 total holdings, and the top 10 holdings make up over 60% of the entire ETF. And what that means is when you see big movements in one of these or multiple stocks in these top 10 holdings, it will move and you will feel it in the share price of this ETF. Now, the sector breakdown is going to be quite easy because 100% of the entire ETF is dedicated to the real estate sector. One thing to point out with this ETF, though, is it is a newer ETF and it has a little bit higher expense ratio as compared to the others we've looked at so far. The expense ratio for NETL is 0.6%. which means for every $10,000 that you invest, you will pay an annual fee of $60. The next ETF to consider for 2022 is more of a mid-cap stock, meaning these are going to be your large, massive mega tech companies that we've been looking at, like your Apples of the world, Amazons of the world, or Microsoft. These are focused more on the middle of the road companies, the mid-cap companies. And this ETF is the Invesco Next Gen 100 ETF, stock ticker QQQJ. Now, many of you may already be familiar with the QQQ, or the triple Qs as you'll hear them called often, which is an ETF made up of large technology companies. These are going to have large holdings in Apple and Microsoft, Amazon of the world. But here is going to be your next generation companies. These are going to hopefully turn into the next Apples of the world or the next Microsoft of the world. So these companies are going to be a little bit smaller in terms of market cap. So if you're looking for that exposure to more mid-cap companies, specifically a lot of technology-based companies, then take a look at QQQJ. Over the past year, shares of QQJ have had a little bit of tough sledding as they've only returned roughly 9% over the past year, and much of this has to do with the fall from grace in a lot of these technology companies that we saw in the fourth quarter, particularly shares of Roku, which are a top 10 holding, which we will see here in the next few seconds. With QQQJ, you're going to have an expense ratio of 0.15%, meaning you'll pay a fee of $15 for every $10,000 you have invested per year. In terms of the sector breakdown, you're going to be heavy in technology with 48% of the funds invested there, followed by healthcare, the consumer cyclical sector, and communication sector making up the top 4 sectors. In terms of top 10 holdings, they include Fortinet, Zscaler, The Trade Desk, Datadog, Old Dominion Freight Line, Etsy, Enphase, MongoDB, Zebra Technologies, and as I had mentioned, Roku. This ETF has a total holdings number of 105, and the top 10 holdings make up 23% of the entire ETF. So with this ETF, if you're looking for some mid-cap exposure, a little bit heavier on the technology side, QQQJ is a great low-cost option for you to look into. The next ETF we will look at is the Fidelity Consumer Discretionary ETF, stock ticker FDIS. Over the past year, shares of FDIS have returned nearly 25%. You get a low expense ratio at 0.08% and even a small dividend yield at 0.77%. As you can imagine, the focus here is on the consumer discretionary sector, one that I believe has great potential in the year 2022 and beyond. Looking at the sector breakdown, as you can imagine, almost the entirety of the funds invested in this ETF are invested either in the consumer cyclical sector or the consumer defensive sector. In terms of the top 10 holdings, they include Amazon, which makes up 22% of the entire ETF, followed by Tesla, which makes up almost 14.5% of the entire ETF. So when you see big movements in either of these stocks, it can have a big impact on FDIS. The next top holdings include Home Depot, Nike, McDonald's, Lowe's, Starbucks, Target, Booking Holdings, and TJX companies. The ETF has a total of 297 holdings, and the top 10 holdings make up over 60% of the entire ETF. So again, if you are looking for exposure to the consumer discretionary sector, then I would definitely take a look at shares of FDIS. But first, I want you to be comfortable with either Amazon and Tesla, because as we saw, this ETF is very top heavy with those two positions, making up roughly 36%, almost 40% of the entire ETF. So if you don't have conviction with those two names, then this may not be a good ETF for you. Now I'm going to give you a bonus ETF. This is going to be a little bit higher risk, and you're going to need this to play out a little bit, but we're going to discuss a Metaverse ETF, stock ticker META. If you've been around investing at, say, the past few months, you have heard the term the metaverse, this imaginary virtual reality that so many companies are looking to take this next step into. Think of companies like Facebook, who are actually changing their name to Meta Platforms and changing their stock ticker from FB, meaning Facebook, to MVRS, which is like Metaverse, or a mumbling version of Metaverse. Companies like Apple, Nvidia, Qualcomm, these companies are getting involved to see how they can contribute and get on the front end of this Metaverse galaxy. I don't know what you call it, but definitely it is something unique and something you definitely want to take a look at. So if you're interested in the metaverse as a whole, maybe this is an ETF for you. But if you just want a little bit of exposure, maybe take a look at the top 10 holdings here to see where you would like to get some metaverse exposure. So let's take a look at those top 10 holdings. They include Nvidia, Roblox, Microsoft, Meta Platforms, which is formerly Facebook, Unity Software, Amazon, Apple, Qualcomm, Tencent, and Taiwan Semiconductors. These top 10 holdings make up 59% of the entire ETF. The ETF as a whole has 41 total holdings at the time of recording. Again, this ETF is a bit of a wild card, and again, it is a newer ETF, so you're going to have a little bit a higher expense ratio to take a look at, and that is currently at 0.75%. So for every $10,000 you invest, you're going to pay a fee of $75. And again, these fees can add up over time, especially as you build your investment dollars over time as well. So definitely make sure you pay attention to those moving forward. And with that, I have given you 6 top ETFs to consider for your portfolio, plus one bonus with our Metaverse ETF to consider for your portfolio in the year 2022. Now, you don't need exposure to all of these, but I wanted to be able to break down and give you some good options, whether you're looking for the S&P 500 exposure, but I also gave you ETFs that were focused on dividend growth. I gave you ETFs that were focused on technology or consumer discretionary or just growth in general, with QQQJ being a middle of the road, a mid-cap ETF. So there's a whole array of different ETFs to look into and see where you want exposure, where you want your money invested in the year 2022 and beyond. I hope you enjoyed the video, and in the comment section down below, let me know your top 2 ETFs for the year 2022. And before you go, again, if you haven't done so already, please do me a huge favor, as it costs you $0, and hit that like button down below, as that is huge for the growth of this channel moving forward. And also make sure you subscribe, because in the very near future, I will be unveiling my entire dividend portfolio in a separate video. So subscribe down below and turn those notifications on so you are alerted anytime I drop a new video. I hope you enjoyed it again, and with that being said, I will see you in the next video. Take care.